Hello and welcome to Business Today. I am Siddharth Zarabi and with me today is Soumya Kanti Ghosh, the Chief Economist at the State Bank of India. Welcome to this conversation at a time when the rupee seems to be in trouble, when globally currencies are, including the pound, has been beaten, and especially at a time when the wizards of the Monetary Policy Committee are going to decide the next course for interest rates in India. In order of importance, I want to start by asking you, what do you expect from the Monetary Policy Committee? A hike is a given, but the extent is a debate.
Yeah, thank you, Siddharth, for having me on the show. I think, Siddharth, the 2050 is now the new 25. So all probabilities, the Reserve Bank has to go with a 50 basis point rate hike just to keep the pace in conjunction with what's happening across the globe. Even though I think recently the Bank of England has given out some confusing signals yesterday in terms of bond purchase and the government. But keeping aside that, I think given the fact that Fed is going to hike by another 75 in November, 50 in December, I think the possibility the Reserve Bank will hike by 50 this time, and maybe as the pace of Fed hikes taper off towards the end of the year, the Reserve Bank can think of also tapering of the pace of increase. But tomorrow, most possibly a 50 basis point rate hike.
What is the impact of a 50 basis point hike going to be on the economy, especially growth?
See, I'll tell you one thing, Siddharth. I think growth surprisingly has been very strong. Some numbers are to be in perspective. Bank credit growth, which is growing at 16%, is now at a more than a 10-year high. And this 16% credit growth is actually driven by agriculture, infrastructure, SME sector, and of course retail. I'll just mention one number. The retail sector, specifically the MSME sector, has actually shown the significant jump in credit disbursement this year. So that goes against the convention or the discussion that the MSME sector was worst affected during the pandemic. So I think it has held up very well. So if I take all these factors into consideration, also the fact that the real estate sector first half sales were 60% across all metropolis. So I think all sectors have been holding back well. And so my sense is that at the margin it could have some impact, but as of now we think that this rate hike could be a positive communication in the markets, in the sense that it is going to protect the currency also to some extent. So from that point of view, I think if the currency gets protected a little bit, I think the markets will take it with a bigger heart, and also the industry, because at the end of the day a large part of the input costs are also imported in the Indian context.
What kind of number for GDP growth for the current fiscal are you currently working with?
See, I think the first quarter GDP numbers were lower than the RBI expectation, but I think it was more of an statistical artifact because the manufacturing sector disappointed because there was a lot of other factors which I will not get into the details. But as of now, I think tomorrow the central bank could revise their growth projections downwards to 7%. We are currently working with an 6.8% growth projections, but there could be an upside to that number in the second half if things continue to do well. But as I said to you, and also the fact that if crude prices continue to decline, currently the RBI assumption has been $105 per barrel. Currently the prices are around $85 per barrel. So if the crude prices remain in this range, I think that could also have some positive impact on the inflation. So if I take all these factors into account, we are working within 6.8% growth numbers today. That's more of a statistical adjustment given that first quarter was much lower than 16.2 RBI projections. But going forward, there could be some sort of positive surprises if things hold up as they're doing right now.
Inflation has been very sticky as far as certain items are concerned, including beverages, fuel. There is a big risk. Artificial block has been put on passing on the natural movements of global crude to Indian consumers, and I believe there will be an inflationary build-up there. And if you look at many of the household segments, what's your own reading of the inflation trajectory from here on, at least till December, if not beyond that?
So I think, Siddharth, before I talk about the inflation numbers, one thing I would actually request, and we have been requesting this for the last 2 years, that we desperately need a revision of the CPI basket. It's based on 2011-12 consumption expenditure survey, where food has a weight of 46%. I think no amount of, guessing could help us believe that food still has a weight of 46%. It could have declined to much lower levels. Now, having said that, and assuming that the CPI numbers as given out holds correct, my sense is that yes, there are some upside risks to the food inflation, because this time the cereal inflation has been running at higher levels, given the fact that paddy output and wheat output are on the lower side. But I don't think that's going to be much of a concern, because a large part of the populace will be protected for the next 3 months from the vagaries in terms of the free distribution. And secondly, I think last time when we had this inflation running in double digits food prices after the crisis, 2009-8 crisis, I think protein inflation also was significantly higher. This time what we are saying is that there is food inflation, but it's sans protein inflation. So if I take these factors into account, I think food inflation, this month's inflation number could be around 7.10 to 7.2%, and next month onwards, the numbers will actually trend downwards, and most possibly we'll get to an inflation number which is lower than 6% in March. So therefore, the RBI will have some sort of respite after September, but as I said to you, given the vagaries of the global uncertainty, I am not sure whether that could still lead to a situation of a pause in the rate hikes. But I don't think that there is too much upside risk on the food inflation, but there are some risk on the horizon.
Okay, let's move on to the rupee. It's become a massive talking point, and I have read your views in the past about the currency. This time, the global movement in the respective currencies, including the pound, where commentators in the United Kingdom are now saying that what is going on with that country, first Brexit, then Boris, and now what is happening to the currency management and unfunded tax cut. What's your sense as far as the rupee is concerned? Is it something that we should be worried about, or do you think it will find a level very soon?
No, I think to your first point, I think yes, what is happening in UK, Bank of England, I think it's Bank of England is actually doing an open market purchase, which means it's injecting liquidity and the government is putting money in the hands of the people. So that's a classic recipe of a fiscal and monetary disaster, and that's why that is pounding that is pushing the pound down, actually hammering the pound. And also there are now talks about that Brexit could actually be downgraded in terms, the UK could be downgraded in terms of the credit ratings. Now, having said that, I think in terms of India, let me put some things in perspective that yes, the rupee has been volatile in the last couple of days. But if I actually look from the beginning of the Ukraine war at the starting point and today, when the rupee is close to 82, I think the rupee has depreciated by around 8.2%. And if you look into the dollar index, that has appreciated by 18%. Now, if we just go back and see what happened after the global financial crisis, at that point of time, the dollar index has appreciated by around 6%, and the rupee actually lost 50% of its value. So clearly, in a situation when rupee depreciation is much lower than the dollar appreciation, it means that the weakening of the rupee is mostly because of the strengthening of the dollar and domestic macro fundamentals. So that's the good part, even though the rupee has declined. Now, if I fast forward it and look into episodes of the rupee disturbances over the last 10 years or even the 20 years, I find that whenever the rupee has depreciated, there has been also a strong case of rupee recovery after the market has actually recovered. This was the case after the global financial crisis when the rupee went to 69, if you remember, in 2013 August, then it reverted back to below 60. So my sense is that the RBI has defended the rupee to a significant extent. It has now spent close to $100 billion. But with a 9-month import cover, I think it will be better for the rupee to depreciate a little bit. In economic parlance, we call it that we should lean with the wind and not against the wind. Let the rupee find a little bit of value, and I think after things improve, things will improve in the next 2 months at the Fed pace of rate hikes taper off, and Indian inflation numbers come lower than expectations, I think rupee will have much ground to cover with. But for now, I think possibly the RBI can let it go a little bit, but not to a significant extent, because a larger depreciation also biggest depreciation, and the market actually then believes that there could be the rupee actually could go even lower. So my sense is that allow it to get to some distance, but after some time, but not to the extent that what I will say, but may not be as may not make it significantly volatile in the intervention strategy.
Just a quick mention from you on the RBI's firepower and the options before it. Like you very correctly pointed out, a massive amount of dollars have been pumped in by the RBI to stem the slide. There are other options before it. Do you expect the RBI to be doing something tomorrow in terms of signaling to the market as far as its intentions on managing India's currency is concerned?
No, I think, Siddharth, that's a very interesting point. Before I answer that, one small data clarification. Even I think a large part of if you actually look at the RBI intervention in the foreign exchange market and decline in the foreign exchange reserves, you will find that the difference is huge. That indicates that a large part of the decline in the foreign exchange is also because of revaluation, because the dollar had relentlessly strengthened against all other currencies. So that we must keep that in mind. So it's not entirely the fall which is explained by intervention. Now, having said this, I think the RBI had spent, if you remember, in the last policy, a considerable amount of discourse was on rupee. I am not sure whether the RBI is going to have the same level of discourse over there, but maybe the central bank could mention a few words about the liquidity normalization. Liquidity recently has been declined to close to neutral levels. Maybe the RBI, maybe the speech could actually find some mention on the liquidity levels. But the central bank may make a mention of the rupee, but may not be to the detailed extent what it meant last time, because last time it had explained the vagaries of this currency in an uncertain world when the Fed is hiking the interest rate.
In your view, has the recent depreciation of the rupee also helped in reversing fund flows?
I think that's also another interesting point. In fact, I think in August, we actually got capital. In August and September, we have got capital flows, outflows was reversed, and we got to close to around 10 billion capital inflows. And that was around 60% of the capital outflows from the beginning of the year. And yes, I think every periods of rupee depreciation actually sees that portfolio inflows rebound after that point of time. That's why I have said at the beginning that is better that the rupee and in fact, if you look into India's portfolio inflows in the last couple of days, even though there is outflow, but this is mostly on the equity, but debt there is still some positive outflow. So my sense is that the sooner the rupee gets to a level, stabilizes at lower levels, I think the portfolio inflows are bound to pick up in the current scenario when the entire world is actually going through this, this ravaging increase in interest rates and the decline in the financial markets.
So if I were to ask you to give us a forecast for the average consumer, come December, what kind of exchange rate number for the rupee would they be looking at?
See, I think it's very difficult to give because no amount of theoretical models has also been able to predict exchange rate overshooting and then undershooting. But my sense is that the NDF market is a good proxy. In the month of August, the NDF market was showing that the rupee actually was more than 80, but we held on to that 80 number towards the end of September. Today, I think 2 days back, we found out that the rate of depreciation was 4.25% from the NDF market, and the rupee actually from the NDF market was around 82 rupees 35 paisa. So if I take all these factors into account, possibly till December, I think recovering over 80 may be a little bit difficult on the part of the rupee. So rupee could actually stay closer to 80 or more than 80 in the next couple of months, because as long as the pace of Fed rate hikes doesn't taper off, I think there will continue to be some pressure on the rupee, given that dollar continues to be, unfortunately or unfortunately, continues to be the reserve currency of the world.
My very final question and a quick answer before we let you go. Again, for the average consumer, what kind of interest rate should they be looking at and the impact on their EMIs at least over the next 3 to 6 months?
I think a simple calculation is that right now a large part of this time what has actually what has happened is that the monetary policy transmission has been quick, because we have now rates which is external benchmark linked rate. So as soon as the repo rate increases, the rate of interest goes up, and our calculation shows that for every 1 basis point increase in repo rate, the total impact on the household and the MSME sector is around 305 crores. So that means the rates have increased from 4%. Maybe if tomorrow, maybe if suppose if it the 200 basis point increase, so the total increase could be around 305 into 200. So that will make around the total impact could be around 60,000 crores on the overall household and the MSME balance sheet. So that's a rough calculation. But if you look into terms of lakhs, I think the number is not that significantly higher. But given the fact that a large part of the demand is not only pent up, but I think happening for the last 2-3 years, I hope that consumer demand continues to remain strong, and the MSME sector has also performed well, and that goes on till we reach a rate whereby till we reach the terminal repo rate.
All right. Soumya Kanti Ghosh, always a pleasure talking to you. Thank you very much for your time with us on the show today. With that, it's a wrap. Do stay with us.
If you like the video, do like, comment, share and subscribe.